All right, the final video for Chapter 6 in Intermediate Accounting, talking about revenue recognition. So we are going to look at step number 5 when it comes to special issues in recognizing revenue. We are going to look at some performance obligations, and then we're going to finish up with the with construction contracts when a contract is happening over time. And that can be definitely one of the more challenging things that we'll be covering in general. So hold tight and stick with me till the end because it could be really helpful. So some common arrangements that have complicated revenue recognition timing, we have licenses, franchises, bill and hold agreements, consignment arrangements, and gift cards. So we're going to walk through each of these individually. So first, let's look at licenses. So a license gives a customer the right to use a company's intellectual property, such as software, music, trademarks, or technology. So in accounting, revenue from a license depends on whether the customer gets access to it at one point or if it's over time. So if they get the license to, let's say it's some specific software, if it's something they just say, here it is, it's all yours now, that would be a specific point in time, and that's when the seller would recognize the revenue. However, if this is something that is performed over time, over several months or years, then it would be broken out accordingly. So we have the right to use the asset. That would be the revenue right at one time, or the right to access it would be over time. Then we have franchises. So, you probably have a favorite franchise. Maybe it's Chipotle, maybe it's McDonald's. There are so many different options, but a franchise, when we talk about accounting, is a contract where the company, which is the franchisor, gives another party, the franchisee, the right to operate under its brand and sell its products or services. So Chick-fil-A is a big one. You have to pay as the franchisee to be allowed to sell Chick-fil-A under their name and to be able to sell that product. So there is a fee just for being able to do that. So franchise agreements often include multiple performance obligations, and that would include licensing, training, and support. So this can definitely be something that is ongoing over many, many years as the franchisee continues to operate under that franchisor's name. But you'll notice that each of these we've been covering are intangible assets. They bring value to the company, even though you can't really see them or touch them or feel them. They bring value to the company, and they're often very expensive. So a franchisor has to evaluate each part of the franchise agreement to identify the performance obligation. So it might be broken out into several different things. So if it's McDonald's and they might say, okay, there's part of it we're just handing over all at once, we're going to recognize that revenue at one point in time. Then there's some things that we're going to give them access to over many years that we will recognize revenue over a time period. So they'll have to break it out into separate performance obligations, quite likely. Then we have a bill and hold agreement. So a bill and hold agreement is when a customer is billed for goods, but the seller keeps the goods in storage and doesn't deliver them right away. So this is not something that you hear about happening a ton, but it all depends on which type of company. Some companies, this is their normal practice. Revenue can only be recognized if specific criteria are met, showing that the customer controls the goods, even if they're still being held by the seller. So this would be a special situation and would only happen within certain types of industries, but the seller is still going to have ownership. They're still going to have physical ownership of the goods, but maybe the actual ownership has transferred over to the customer. And if it has, then they're going to go ahead and show the revenue. It all depends. Maybe it is a horse. This is something that in the area that I live in, there are a lot of people who own horses, but they don't actually have them at their house. So they might still live at the farm and somebody still helps take care of them, but the ownership is actually on the buyer, even though they have not brought the horse to their property yet. I just came up with that example just now. I'm kind of proud of myself. You're not. Okay. So then there's consignment arrangements. Chances are you've probably been to a consignment store before, and that's exactly what we're talking about here. So this is how the accounting works with that. So a consignment arrangement is when a company, the consignor, delivers the goods to another party, the consignee, and then that party sells the goods on behalf of the customer. So you go to a consignment store, they've got, let's say it's clothes, they've got all these different clothes, and the actual store doesn't own any of that. It's actually going to be, they're selling it on behalf of all of the consignors. And then revenue is not recognized until the consignee sells the goods to a third party. And at that point, they are just going to record any commission, any portion they got of the sale. So example, Sunset Sound Systems ships 100 speakers to a music retailer under a consignment agreement. The retailer holds the speakers in the store but doesn't pay Sunset until they're sold. Sunset does not record revenue until the speaker is sold to the customer. So it's still under Sunset's ownership even though it is at this retailer's store. Then once the retailer actually sells it to a third party, the retailer keeps a portion of it, whatever they agreed upon, and then Sunset gets the rest, and that's when they would recognize revenue. So even when they're recording inventory, Sunset will include the speakers in their inventory, even if it's at the location of the retailer. Then there's gift cards. I love gift cards. That is the best gift. I mean, maybe not the best gift ever, but it's a really good gift, right? So a gift card is a form of prepayment by the customer, maybe by your grandma, right? The company receives cash before delivering goods or services. That creates a contract liability. So that is going to be deferred revenue. So your grandma goes to Hobby Lobby, purchases a gift card for $50 for you. Hobby Lobby has to show a debit to cash and a credit to the deferred revenue account. Sunset Sound System sells a $100 gift card on July 1st. The customer redeems it in August. They're going to recognize the revenue in August, and they are going to, in this case, it was $60 that they actually spent in August. So the other $40 is still going to be a liability. Of course, companies love to sell gift cards because then you go into Sunset Sound Systems and you actually spend $110 ultimately. So not only do they get your grandma's $100, but now you spent an extra $10. And then if you never come in and use it, they just got $100 for nothing. They didn't have to do anything. So that's nice too. We don't get too far into gift cards in this chapter though. All right, and then the last part of chapter 6. Don't get too excited. There's going to be a lot more with this. So it's not going to be a short and sweet thing. But this is step 5, accounting for long-term contracts. This is over a period of time. So when it comes to long-term contracts, step 2 and 5 are critical. So step 2, identify the performance obligation. Is it a single performance obligation or is it going to be over time? 5, recognize the revenue when or as each performance obligation is satisfied. So there may be multiple performance obligations within this long-term contract that you can show recognition of revenue over time, depending on the situation. So let's look at Sunset Sound Systems. Beginning of 2025, they received a contract to build an event center for $5 million. They're really getting up there. they're really scaling their business. Sunset will construct the building according to specifications provided by the buyer, and the project is estimated to take 3 years to complete. According to the contract, Sunset will bill the buyer in installments over the construction period according to the prearranged schedule. So they've already talked to the buyer about this. Okay, we are going to complete this much in year 1, this much year 2, this much year 3. We are going to bill you according to this. They have a whole prearranged schedule and discussion. But ultimately, it's a contract for $5 million. So bear with me as we look through this chart. The construction costs incurred during the year, we look at 2025 first. They incurred $1.5 million. Construction from prior years, there was no prior years in 2025, so it's 0. So cumulative actual construction costs were $1.5 million. The estimated cost to complete it at the end of the year is $2,250,000. That's how much they still have to spend. That's their estimate. It's never going to be perfect, but that is their estimate. So when you add what they've already spent plus what they estimate to spend in the future, their total estimated construction costs are $3,750,000. Billings made during the year were $1.2 million. That's what they billed the buyer. And then they collected $1 million. I would recommend that you take a screenshot of this, take a picture of it with your phone or something like that as we go through the rest of the slides after this. Then we jumped to 2026. They incurred another $1 million in cost. In 2025, they had 1.5, so that was their prior year's cost. So total, they've spent 2.5 million. They expect to spend another 1.5. That would mean total, we'd have 4 million in costs. You see that's already gone up 250,000, just 250,000 from 2025 to 2026. So we're up to 4 million now is our estimated total cost. They have now billed the customers 2 million during 2026, collected 1.4. Part of that was from 2025. Then we jump to the final year. They incurred 1.6 million. They thought they had 1.5 million left. It was 1.6. They've already incurred 2.5, so their total cost was 4.1 million. Here they were at the end of 2025 thinking it was going to be 3.75 million. They are actually finishing in 2027. That's shocking. That's got to be a record to finish construction in the same year that you predicted. And they bill the customers another 1.8 million and they collect 2.6. So total, if you calculated how much they billed them, it's the 5 million. And then total, if you calculated how much they collected there at the bottom, it's the 5 million as well. So they were a good paying customer. So again, take a picture of this so we can move to the next slide and you'll be able to move with these numbers and understand where they're coming from. Okay, so important before we look at the journal entries, there are two accounts I'm going to introduce you to right now. Are you ready? One is CIP, Construction in Progress. It's an asset account that records the cost of a contract the contractor incurs during a long-term construction project, such as materials, labor, overhead, all of these costs that they're incurring. It represents the work completed but not yet billed or collected. But notice, it is an asset account. So it's all the costs that they've incurred, but they haven't actually billed or collected for yet. So it's basically like inventory, right? It's almost like a work in progress account where they're saying, okay, we have everything here, but we haven't billed the customer yet. So it's basically an asset. It's almost like inventory to us. Then the next account is billings on construction contract. That is a contra asset, or it could be a liability, that tracks the amounts of the contractor that the contractor has billed to the customer for the work performed. It shows how much has been invoiced compared to how much work has actually been completed. So we've got construction in progress, then we've got our contra account of how much we actually have billed them for. So the difference there will help us to see what the gap is. So here are our entries for the 3 years. So every year we're going to show the construction in progress as they incurred costs. So that was that top number on the first slide. The first year they had 1.5 million in cost. We had cash or materials, any kind of inventory that left, and we put that into this asset account that is a lot like a work in process account. And then we did that each year as we incurred costs, or as Sunset incurred costs. Then we jump down to billing the customers. So when we bill the customers, they haven't paid us yet. We show accounts receivable for the amount we billed them for, and then we use that contra account, billings on construction contract. And so those will match up with the ones in those charts as well as we build them. Then as they collected the cash, obviously, we'll show cash coming in. This was the bottom number on that first page, that first slide. And then we'll show accounts receivable decreasing so we can keep track of it. So that's what's going to be happening with our journal entries all throughout these 3 years. So if we were just going to recognize revenue when we completed it, we would just make this one entry. Construction in progress would be showing basically the profit that we made, which was 900,000. The cost of construction was 4.1 million. If you add it all together, what we paid, or what Sunset had to pay, it was 4.1 million. The revenue was 5 million. So it's basically profit of 900,000. That's if we recognize it all at the end and we didn't do those entries leading up to it. If we want to show it over time, just like this, it would be the same accounts, but you would just show over time as we had the cost of construction compared to the portion we had completed, and the difference would be the profit. All right, so those were two different approaches that we're looking at. So here's if we're looking at these two new accounts and how the journal entries, if we looked at those 3 different years of journal entries, how they would look. So we have the construction in progress. This is where, okay, each year, and I'm sorry that this should be 2025, 2026, 2027, but each year they're showing the progress. It was 1.5 million, then we added another 1 million, then another 1.6. That totaled all of the costs that we had spent, which was 4.1 million. Then we had billings on construction contract, and as they billed them, we showed that as a credit for the contra asset. So that ended up being 5 million. This 900,000 here in pink is going to represent what the gross profit was, our billings compared to our cost. The difference is 900,000. So at least they did well. Basically made 300,000 a year if you want to think of it that way. All right. We're getting close to being finished with this. It's not a fun part. It'd be easier if I could show you on a whiteboard, but at least we're getting to walk through it some. Recognizing revenue over time using this percentage of completion method. So we take the total estimated revenue, the cumulative revenue to be recognized to date, times the percentage completed to date. And I'm going to break this out for the 3 years. It's going to look a little bit overwhelming, but hopefully it will help you to understand it. So we're figuring out how much revenue to recognize each period. Total estimated revenue, the 5 million, times the percentage completed to date, minus any revenue that we've already recognized in prior years. So let's work through this using this formula. All right, so 2025, the construction costs were 1.5 million, and we know our total contract was 5 million. I'm sorry, this looks like so much, but I'm going to say it. You can rewind it, listen to as many times as you'd like. We take the construction cost year to date, and we divide it by the total estimated construction. See the 3.75? And that tells us we're 40% done. 40% of 5 million is 200,000. So they'd recognize revenue of 2,000 in the first year, 2 million. Just a couple zeros. And then we move over to 2026. We add together all of the costs to date, 2.5 million, divided by the estimated total cost, tells us we're 62.5% of the way complete. And then we multiply that times 5 million. That tells us that total revenue we should recognize at this point was 3.125 million. Of course, we've already recognized 2 million, so we should only recognize the difference, 1,125,026. Then we say, okay, total we have cost of 4.1. That's all that we're expecting to have because we're done. So 100% is done. We should recognize all 5 million, but we've already recognized 3,125,000. So we need to subtract that out and recognize the difference as in revenue. Take a minute, let that all soak in, work through it. I'm going to move on, but you don't have to yet. All right, so this is just like what I was showing you. At first, it tells us, okay, we're going to show the profit. We're going to recognize 2 million the first year minus what we've already spent. So our gross profit is the difference of 500,000. Then in 26, we said total we should be recognizing 3,125,000. And if you're like, where are these numbers coming from? You can rewind, take a picture of the last slide, and you'll see where these are coming from. We've already recognized $2 million in revenue. So now we only need to recognize a total of 1.125. Subtract out the cost for 2026. It gives us gross profit of 125,000. Then in the final year, it's time to make sure we recognize all 5 million. Subtract out the amount we've already recognized. So our revenue will be $1,875,000 minus the cost of construction for the year. It'd be $275,000 in the final year. So this is how we would be recognizing revenue, the cost, and then the profit for each year. All right. Last entry. This is just closing out the contract. At the very end, we want to close it out. The job is finished. We need to get this off of the balance sheet. This is not ours anymore, so we're going to get rid of the billings on contract account by debiting the $5 million. That was the contra asset, and then we credit the $5 million on the construction in progress. And that's it. I made it sound like it was easy by saying that's it. I know it was a lot, but just work through it. Watch the video as many times as you need, and just know that you're done with chapter 6. It's not the end forever, but it is with chapter 6.